Let's talk about 4 awesome dividend ETFs slash index funds. Now, I call dividend ETFs autopilot passive income because all you have to do is invest a little bit of money and you're collecting dividends on a frequent basis and you don't have to do anything for it. It's extremely passive. Another benefit is also that you are immediately diversified in dividend paying companies that you're getting your income from. You don't have to go out there and do the fundamental analysis to make sure that you're picking and choosing the correct dividend stocks to purchase in order to get that dividend income. Also, the fund managers of these dividend index funds and dividend ETFs, they are managing this dividend ETF and making sure that they're buying and selling the right dividend stocks for that portfolio. And all this is a big benefit because even myself, I'm a value investor. So that means I like to analyze companies using a screener, add them to my watch list, and buy them at the right moment. But even myself, I see the benefit of having a dividend ETF because it's not only about buying these companies, it's also about managing them, maintaining them, making sure that the companies that you bought are still good enough to be in your investment portfolio. And if you're the type of investor that does not have a lot of knowledge or time to go out there and analyze individual stocks, a dividend ETF or index fund is the right way to go. Now, can you get rich off dividend ETFs? You definitely can. It's more of a slow process because with the dividend ETF, the price of your ETF is going to fluctuate, of course, but your dividend income, you will get that on a frequent basis. So it's more of a slow and steady way of building your wealth. But it's more stable, it's more consistent, it's something that you can rely on. If you're just starting out investing and you're really interested in how dividends work, that's the best place to start. Start out with a dividend ETF, see what type of companies are in your dividend ETF, and then you can take it from there. If you want to take the next step and then invest in individual companies, you have a good baseline to start with just by looking at some of the companies that you are invested in the dividend ETF. However, for this hands-off approach, you will have to pay a fee, which is called the expense ratio. But the expense ratio is so low, it's worth it. It's worth it to just invest in a dividend ETF compared to using your free time to start analyzing companies and you're not even sure and you're not even confident in what you're investing in. At least with a dividend ETF, yes, you're paying the fee, but you know that you're investing in the right type of fund that will see your wealth grow. Now, looking at the first ETF, this one is going to be the VIG, which is the Vanguard Dividend Appreciation ETF. If you're looking for the index fund equivalent, you want to go with the VDADX, which is the Vanguard Dividend Appreciation Index Fund Admiral shares. Now, with this ETF, 97 to 98% of it is invested in US equity, which pretty much means US companies. All large cap companies, out of those large cap companies, 20% of those are invested in the financial sector. And the top 3 companies are United Health Group, Johnson & Johnson, and Microsoft. This fund has an average 2% when it comes to the dividend yield. Dividend yield explains simple. How much dividend are you getting for the price that you're paying? So if you paid $100 for an ETF and the dividend yield is 2%, you'll get $2 in dividend income. So yes, this is a 2% dividend yield on average. And then the expense ratio is extremely low for the dividend ETF at 0.06%. And going back to the dividend yield, don't look at a lower dividend yield of let's say 2% as a bad thing because with that dividend yield of 2%, whenever you get a dividend in an ETF or an index fund, you're actually reinvesting that dividend to buy more dividend paying companies. So in this case, that 2% allows you to compound your money and build your wealth. Number 2 is the Swap US Dividend Equity ETF, also found under the ticker symbol SCHD. Now, with this particular ETF, 99% is invested in US equity, all large cap companies, with the highest percentage being in the financial sector, which is 21%. And then the top 3 companies are Merck and Company, Amgen, and IBM. This ETF also has a very low expense ratio at 0.06%, and then the dividend yield is a little bit higher at 3%. So SCHD is a must-have in your investment portfolio. Number 3 is the Vanguard High Dividend Yield ETF, which you can find under the ticker symbol VYM. And then if you're looking for the index fund equivalent, it's going to be VHYAX, which is the Vanguard High Yield Dividend Index Fund Admiral. Now with this ETF, 97 to 98% also invested in US equity, also large cap companies, but the top 3 sectors in this case are going to be financials, consumer staples, and healthcare. And then the top 3 companies in this ETF are ExxonMobil, Johnson & Johnson, and JP Morgan. This ETF also has a very low expense ratio at 0.06%, and then the dividend yield on this one is also 3%. And number 4, this is the highest dividend yielding one, which is the VNQ, which is Vanguard Real Estate ETF. Now in the real estate sector, you will always have a higher dividend because they pay a higher amount of dividend income out of their net income. With this particular ETF, 99 to 100% invested, of course, in US equity, mostly mid-cap companies. And then this ETF does have a little bit of a higher expense ratio at 0.12%, but not that high compared to what you will see when you look at mutual funds. This ETF is 100%, of course, invested in the real estate sector. And then the top 3 companies are Prologis, American Tower, and Crown Castle Company. Another great benefit that you have with investing in dividend ETFs compared to a growth ETF will be what's happening in the stock market. Because if you think about the bull and bear market, so a bull market is whenever the stock market on average is trending up, we're in a bull market. But the bear market is the opposite. So whenever the stock market is trending down, we're in a bear market. Whenever the economy is in an uptrend, people are more optimistic and they spend more money on consumer goods and even services. They also spend more money in buying investments. So the stock market is going to rise. But in the bear market, people are pessimistic. The economy might not be doing too well. We see sky high inflation. So people might panic and sell their stock. They might sell their shares. They might even sell their ETFs. So by investing in a dividend ETF, those can weather the storm better compared to other types of ETFs, such as a growth stock ETF. The easiest way of looking at dividend ETF investing is by also thinking about dollar cost averaging. With dollar cost averaging, you're investing a specific amount of money at a frequent basis. So for example, you might be investing $100 every week, or you might be investing $1,000 every month. With dollar cost averaging, you're allowing yourself to buy stocks, or in this case, ETFs or index funds. It doesn't matter if the price of the ETF is up or down, it always averages out because you're adding more money to your ETF when the stock market is in a bull market, but also when it is in a bear market. That means you're averaging it out. It's a way of investing without being emotional about investing. You're taking your emotions out of investing because more than likely, if the stock market is crashing or we are in a downturn or an economic recession, you're less likely to invest. But with dollar cost averaging, you're allowing yourself to invest when stocks and even dividend ETFs or dividend index funds are selling at a discount. So you're buying them cheap. Looking at these dividend ETFs and even thinking about dividend paying companies, if you want to find individual ones, there are different methods that you can use. One of those methods is the dogs of the Dow method in buying dividend paying companies. So with the dogs of the Dow, if you look at the Dow Jones Industrial Average, that consists of 30 high quality blue chip companies. A blue chip company is a stable company that is the leader in the market. It has a track record of success, and it's a large cap company or even a mega cap company. Now, with the dogs of the Dow method, the Dow consisting of 30 high quality dividend paying companies, what you do is you take 10 companies out of the 30 that have the highest dividend yield and you buy them at the beginning of the year. You wait a whole year and then you do the same method. Now, the reason why you want to take the 10 highest yielding dividend paying companies is because the dogs of the Dow already has 30 high quality companies. And if a company has a high dividend yield, that means that the share price is low compared to the dividend yield, which means that in the future, potentially, the price of the stock is going to go up anyway. So you're having a double effect of collecting the dividend, but also waiting for the share price to potentially go up. Another method that a lot of dividend investors like to use is to look at a specific list, such as the dividend kings, the dividend aristocrats, the dividend champions, or the dividend achievers. These are lists of dividend paying companies that have paid a continuous dividend in the last 50, 25, or even 10 years. So the dividend king is a list of companies that have paid a continuous dividend for 50 plus years. The dividend achievers is a list of companies that have paid a dividend for at least 10 years. One thing to pay attention to though, even if you look at these lists with companies that have paid a continuous dividend, you want to make sure that on a yearly basis, the dividend growth has been higher than inflation. So to me, it doesn't matter if a company has been paying out a dividend for 25 years. If they don't increase their dividend on a yearly basis faster than inflation, then that's not a company that I invest in. So why go for an ETF versus an individual stock? Now, you can still do both. You don't have to pick and choose one or the other. But with the ETF, like I already mentioned, you have immediate diversification. You have a fund manager or multiple fund managers that are managing that ETF compared to a individual stock where you have to go out, do the research. You don't have that immediate diversification because it's just one company. But what I've noticed by investing in individual companies is that my dividend yield is better compared to the dividend ETFs. But there's a price that you have to pay. The ease of investing using the dividend ETFs or going out there and analyzing specific companies and then adding them and buying them when they're selling at a discount, you will get a better yield. So if you look at the two, you just have to weigh the risk with the benefits. Now, another question that you might be thinking of, a dividend ETF versus a growth stock ETF versus an S&P 500 index fund or ETF. Which one of these three should you be paying attention to? Like I always say, you don't have to pick and choose a specific one because the better portfolio would have a specific amount of money invested in each of them. Now, if you want to make it more technical, yes, you can have those three ETFs, dividend, growth, S&P 500. But then I'm also going to add a bond fund, so a bond ETF, an international ETF, and then you can also add some individual companies, whether they might be growth companies or even dividend paying companies into your investment portfolio. I like dividend ETFs. I'm always going to be a value investor who likes to invest in individual companies, but I definitely see the benefit of investing in ETFs because even myself, I don't always want to analyze specific companies and then always have to manage them, making sure that they pay their dividends on time, make sure that they didn't cut or stop paying a dividend. In an index fund or an index ETF, you don't have to worry about all that management because the fund manager is being paid to manage and handle all these different issues that might pop up. So for example, I invested in the Disney Corporation and a couple of other companies when they paid out a dividend. But the Disney Corporation and these other companies ended up stopping their dividend payments. So I was able to catch most of them at the time that they stopped the dividend payments. But some of them I didn't know about until I logged in to see if I got my dividend payment. And I noticed that I didn't. And I had to figure out why. And that's when I noticed that these companies also stopped paying their dividend. With an ETF, I wouldn't have to manage all this. I wouldn't have to be able to keep up to date with all these dividend paying companies. That's why the dividend ETFs and the dividend index funds that I talked about are a big plus and a big advantage in my book. Let me know which dividend ETF or dividend index fund you're interested in from this list. Leave a comment. Also, make sure to like this video and subscribe to my channel. And I'll talk to you in the next one.